With a global voice then, and William Faulkner is the Vice President Sovereign Risk Group at Moody's Investor Services, now joins in to talk about the macros and the fine print in the budget. Great to have you on board, William. To begin with, the government has pegged the FY20 fiscal deficit at 3.4%. Now, given this is an election year, do you think that the budget has been populist in nature or a rational one? What have been the key hits and misses, according to you?
Well, the key focus for us really is the extent to which the budget maintains the fiscal consolidation roadmap that the government had set out last year, particularly with regards to the FRBM targets. We had expected a 3.4% fiscal deficit target realization this year, which was aligned with our expectations, modest slippage from the 3.3% target. But next year, the 3.4% pause was something we had not anticipated. We had expected a continued reduction in the fiscal deficits along the terms of the roadmap. The original target had been 3.1%. So the question then from our perspective really is what was behind that veer from the target, and ultimately what the composition of spending will be and to what extent that will support growth to the economy. And so that's really what we're focused on right now, is both the expenditure side. Obviously, the focus has been on a new program to support direct income transfers to farmers at the lower end of the income spectrum, as well as some tax cuts for the middle class on the revenue side. And so those two things, when added up together, ultimately result in a slippage from the targets for fiscal 20.
You mentioned that continued slippage has credited negative for sovereign. However, government is committed to reach a fiscal deficit of 3% for FY21. So given the backdrop of reforms taken, do you think the fiscal targets are realistic?
So that's a very good question. The government did note that they intend to pursue the target of 3% in fiscal 21. So the fiscal consolidation, the glide path as they call it, didn't change. However, the annual path to get there did change. So we see that as ultimately that's going to be more challenging because going from 3.4 to 3% from 20 to 21, it will be difficult ultimately, and it's difficult. Obviously, that's farther out in terms of the spectrum today, but ultimately it's going to require greater progress on the revenue side through higher collections, as well as enhanced expenditure efficiency. And right now, it's going to really depend on implementation of the new programs that they announced and ultimately growth. And your second part of your question had to do with growth. We do expect this year's budget to be supportive of growth. Ultimately, the income transfers and the tax cuts will support consumption, and so that should be supportive of growth. Our expectation is for growth this fiscal year of 7.2% and 7.4% for next year, and these would be supportive of that.
Right. William, your view on India's sovereign rating post the interim budget then, and key factors that you would look out for going ahead and maintaining your review and stance in India?
Well, our views haven't changed on the rating, let's say. Ultimately, the credit profile for India has not been materially altered in any meaningful way from the budget. However, what I will say is that the key challenge for India's credit profile is fiscal strength, and to improve on that front, there needs to be a gradual reduction of deficits and ultimately a reduction of the debt to GDP ratio, which today for the general government, and that's how we look at things, not just the central government, which this budget focused on, but in aggregate, the consolidated general government, which includes the states. And obviously the states have been deteriorating, slipping as well as the center more recently. And so when you add those up, India's debt to GDP ratio today is close to 70%. And the challenge moving forward is going to be ultimately to bring that down to closer to the median where we see India's peer group of the BAA space, which is where India sits on our credit rating spectrum, which is actually below 50%. So there is a significant gap between India's debt to GDP burden and ultimately that of the peer group. And for India's credit profile to improve and ultimately support a higher, basically a higher rating in the future, you'd need to see continued gradual improvement on that front. And this budget doesn't really give us clarity as to how that will be achieved based on fiscal slippage.
William, what's the view on the assumptions on the revenue front, both tax and divestment, and the overall quality of fiscal consolidation?
Sure. On the revenue side, this year's budget there were no necessarily any positive changes that we'd expect to support increased revenue moving forward, unlike last year's budget, which focused very much on indirect taxes and a big increase in GST collection from 2.6% of GDP to 4%, which at the time we considered ambitious, and obviously that's playing out this year with a shortfall based on several changes, based on changes to GST rates as well as to the exemption limits. Next year, obviously, when you look at the continued challenges around GST implementation and the cuts that I just mentioned to rates and changes to exemptions, it's going to be more difficult to collect higher GSTs from this level because you're effectively thinning out the tax base on that front. In addition, you obviously have some
William, let you go on that note. Thanks very much for joining.